Imagine opening your broker app in 2026 and realizing that every month, something is dropping cash into your account. Not a tiny 58-cent dividend that barely pays for a coffee. I mean, like real income deposits that make you feel like your portfolio is actually working for you. And then you notice something interesting. It's not coming from 20 different tickers, but from just 2 ETFs working together like an income machine. Most people are still arguing about which S&P 500 ETF is the best, or whether Nvidia is overvalued. Meanwhile, a small group of income-obsessed investors are quietly stacking cash flow from a high-yield duo that barely shows up on the big YouTube channels yet. So in this video, we're going to talk about 2 ETFs that, combined, could turn 2026 into the year your portfolio finally starts paying you every month without you having to guess the next hot stock. Now, let me ask you this. What do you actually want from your investments in 2026? Do you want a graph that goes up slowly while you never touch the money? Or do you want real visible cash flow hitting your account regularly? Because if you're watching this channel, I'm guessing you're at least a little bit in the pay me now camp. You don't need a lottery ticket. You need a system. And that's exactly how I want you to think about this duo. Not as magic, not as a guarantee, but as a cash flow system built out of 2 very specific, very aggressive income ETFs. Let's start with the first half of the duo. We'll call it the Income Engine. This one is Canadian listed, launched in January 2025, and it's basically a basket of single stock covered call ETFs all wrapped into one. Inside it, you've got enhanced income exposure to names like Nvidia, Tesla, Apple, Microsoft, Amazon, Broadcom, Meta, Palantir, Netflix, Eli Lilly, Costco, and more. It's like somebody took a list of trending growth companies and said, cool, now let's make them pay high monthly income. As of late November 2025, this ETF trades around 13 Canadian dollars per unit and pays about 26 Canadian cents per unit every month. That works out to a current yield hovering around 24% annually, paid monthly, based on the recent distribution and price. It even has a 0% management fee at the ETF level, though of course you still indirectly pay the fees of the underlying Harvest single stock ETFs that use covered calls and modest leverage to generate that high cash flow. Here's the hook. This ETF alone is already enough to make most traditional dividend investors do a double take. While they're fighting over whether 3.5% or 4.2% is a good yield, this thing is sitting there in Canada just casually throwing off around 24% in distributions, month after month, based on recent data. If you're building a 2026 income plan and you ignore it, you're basically choosing to play income on easy mode. Now the second half of the duo is where things get wild. This one is US listed, launched in August 2025, and it pays monthly. The fund is designed as an ultra-short option income strategy. In plain English, it takes short positions in a small portfolio of US stocks, sells options on them, and turns that option premium into frequent cash flow. As of late November 2025, it's got roughly $29 million in assets, trades in the high 30s per share, around $37, and has an expense ratio in the low 1% range, roughly around 1.1% to 1.2%, depending on whether you look at gross or net figures. Here's where income investors' eyes really light up. Right now, the real data shows a high teen yield, around 18% based on actual monthly distributions, not the unrealistic 70% plus annualized projections some sites throw around. On top of that, it's paying out every month, with a stream of frequent distributions that, when annualized, create those huge headline yield numbers. It's aggressive, it's unusual, and it is absolutely not a boring ETF. So let's put this together for a second. On one side, you've got a Canadian ETF built around Harvest's single stock covered call strategies on big names like Nvidia, Tesla, Apple, Microsoft, and others, paying roughly 24% annually in monthly distributions. On the other side, you've got a US Yield Max ETF that aims to generate high monthly income through an ultra-short option strategy, currently showing a realistic trailing yield in the high teens, around 18%, based on actual distributions, not exaggerated annualized projections. If you're looking at 2026, this duo builds a powerful income rhythm, monthly CAD payments from one ETF paired with high-teen USD monthly income from the other. Now it's time to actually name them. The first ETF, the income engine in Canada, is HHIS, the Harvest Diversified High Income Shares ETF. It launched on January 2025, and its whole goal is right there in the name, Diversified High Income. It holds a portfolio of Harvest's single-stock enhanced income ETFs, uses modest leverage at the underlying level of about 25%, and as of late November 2025, it's sending out that 0.26 CAD per unit every month on a roughly $13 NAV. If you've ever wanted a one-ticket way to get covered call income from many of the top growth names at once, HHIS is exactly that. The second ETF, the income accelerator in the US, is SLTY, the Yield Max Ultra Short Option Income Strategy ETF. So it launched on August 2025, sits on NYSE Arca, and right now it's got around $29 million in assets. The expense ratio is a bit over 1%, and as of November 2025, it's paying out monthly distributions that, when annualized, translate into those huge distribution rate numbers. It's the kind of ETF you look at and just think, okay, this is serious income. I really need to understand what's going on here. Notice how these two funds actually complement each other. HHI's leans into high-income covered call strategies on trending single names, with monthly cash flow in Canadian dollars. SLTY leans into ultra-short option income on a small portfolio of US stocks. One gives you diversified exposure to some of the most talked-about growth names on the planet, while the other is more of a pure income engine that doesn't really care about being popular. It just cares about harvesting option premium. Now, before anyone gets too excited, let's keep it real for a moment. Yields this high are never a free lunch. Both of these ETFs use more complex strategies under the hood. Payouts can change. Parts of the distribution might be classified as return of capital. Net asset values can move around too. In a strong bull market, you might underperform a simple growth ETF, but in a choppy or sideways market, you might be pretty happy to see cash still coming in while everyone else is staring at flat charts. The point isn't that these are magical or risk-free. The point is that they are tools, and in 2026, they're some of the most interesting income tools available. So, what could an actual investor do with this duo? Imagine a portfolio where HHIS is the core monthly payer, a big, steady Canadian dollar income stream built on names you recognize, like Nvidia, Apple, Microsoft, Amazon, Tesla, and more. Then imagine adding SLTY on top as your USD income booster. Not huge allocations, but steady high-teen monthly payouts that make your income stream feel alive. Together, they create a pattern of potential income that looks very different from a traditional 3% dividend fund. If you're still here, first of all, you're the type of investor I like talking to. Patient, curious, and not allergic to numbers. Second, let me know in the comments. Would you rather have one big payout every quarter or lots of smaller payouts every month and every week? There's no right answer, but your preference says a lot about how you should build your income portfolio for 2026. If you found this breakdown helpful, and you like videos that actually dig into how these ETFs work instead of just throwing around tickers, consider subscribing to MoneyQuest Broker. It really helps the channel grow and motivates me to keep bringing you deep dives into high-yield opportunities like HHIS and SLTY. And one last thing. This video is for educational and informational purposes only. It's not financial advice or a recommendation to buy or sell any investment. Yields, distribution rates, prices, and other numbers mentioned here are based on recent data and can change at any time. Always do your own research or speak with a licensed financial professional before investing, and never buy something just because you saw it on YouTube. Buy it because you understand it.